please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Just keep an eye out on the markets. Well, select stocks are seeing selling. Tata Steel has slipped from the high point of the day. So pull up that stock. It's down close to around 0.7%. GAIL as well is seeing some selling pressure. So keep an eye out on that one as well. Well, let's get into market opinion then. Here's a word coming in from Naren of ICICI Prudential AMC. He says that barring earnings, we have reached a mature phase of the bull market. Let's listen in.
Our belief is there is a scope for a pop in April, May because of seasonal reasons. As you know, globally, it's always sell in May and go away. So we have a scope for a trading rally from here. I think small caps continue to be overvalued and mid caps are clearly also overvalued. In the large caps, there are a number of stocks which are cheap, but they all seem to be cheap with a reason. But having said that, I would say large caps are certainly more reasonably valued than both small caps and mid caps at this point of time. We chose a theme like consumption. If you look at consumption, if you want defense, you've got consumer staples and healthcare. If you want offense, you've got consumer durables and autos, which are all at closer to highs. If you want to play contra, you've got sectors like telecom and power. I think barring earnings, we have reached a mature part of the bull market. There was only one thing which did not happen in this cycle, which was good earnings growth. Locally, there is scope for volatility over the next 12 to 18 months. Over a period of time in the phase before elections, consumption is one of the better themes to invest in. And clearly, the government is likely to give a thrust to consumption in the next 12 to 18 months.
Okay, focus on consumption. We'll slip into a very short break with the news that the markets have slipped some more, so now up only about 54 points on the news. Essar Steel's insolvency resolution process is now poised at a critical juncture, even as the Committee of Creditors will be meeting today to decide whether to have another round of bidding. One of the parties, New Metal, whose bid was considered ineligible by the resolution professional, has approached the NCLT, the Ahmedabad NCLT, to reinforce its eligibility to participate in Essar Steel's resolution plan. For more on this update, we are once again joined by Ritu Singh. Ritu?
Well, Reema, just hours before the Committee of Creditors was set to meet to decide eligibility of both the two players that had submitted bids and to debate whether or not to re-invite bids for the company, New Metal, which is one of the two bidders, has moved the Ahmedabad NCLT to reinforce its eligibility when it comes to submitting a resolution plan for Essar Steel. The need for this plea, according to the New Metal statement, was because they were apprehensive that their bid would not be considered properly by the Committee of Creditors, and they claim that they have put all of the facts of their eligibility in front of the NCLT Ahmedabad for an objective view on their bid. They say the IRP has not completely considered all of the facts in the case before they decided that the bid was ineligible for Essar Steel, and therefore they have moved the court, and the court in fact has also ruled, this is according to the statement given out by New Metal just now, that the Committee of Creditors, which is set to meet today, will have to take into account the final order in this matter of New Metal's eligibility before they come to any conclusion about the sale of the company. So this will be an important development that lenders will have to take into cognizance as they meet today to decide the fate of Essar Steel.
Okay, all right. Thanks so much for that, Ritu. Well, moving on then, Transport Corporation of India has acquired a new ship which will be deployed on the west coast of India. This will help increase the company's overall capacity by close to around 65 to around 70%. Mr. Vineet Agarwal, the MD of Transport Corporation of India, joins us on the phone line. Hi, Vineet. Thanks so much for joining in. Well, just going by the capacity, it appears that your total capacity will increase by around 70%. Seaways is what? Around 12-13% of your total revenues. Will your revenues from your Seaways segment itself increase proportionately by more than 50%?
Hi. Yes, so the acquisition is about for a ship, second-hand ship of about 26,000 tons. And typically what happens when we add new capacity, revenues tend to go up in proportion. You're absolutely right there. This is to be deployed on the west coast from Mundra to Cochin, and this is all a container ship. And we are seeing that there is good traction in this area, and hence we decided to add this capacity.
Vineet, afternoon. So in year one, what could be the incremental revenue from this ship? In year two, how do you foresee, or what are your revenue projections from the same?
So overall revenues for the division is, as was mentioned, under 15%. And in overall percentage, because of growth of other divisions as well, even with this augmentation of this capacity, overall revenues will not exceed that 15% of the company. We estimate that the Seaways division should record a close to between 240 to 260 crores of revenues this year. And we estimate that it should grow to another maybe 325 crores by next year.
Only 325 crores, Vineet. Your capacity is going up by 70%, but you're saying your revenues from your CVS business itself will go up by only around 25-30%?
See, what happens is that first is that the full year implementation does not come right away. The ship is being acquired today, but it will actually come onto the actual Indian waters, and then we'll start optimizing the utilization. It will take a few months. Also, what happens typically, some other ships also tend to go out for dry docks and repairs. And so one or two ships will do that as well in the coming financial year. So the net impact is not exactly as is in terms of capacity addition, but more in terms of the overall utilization of all the capacities.
So what would be your utilization, say, in year one? And, while the system gets in motion, will you be making profits on this, or will it generate a loss in the early years? How does it work?
So the year one capacity utilization, so firstly, the capacity utilization on the sector is 50-60%, because when we move cargo from Mundra to Cochin, it's 100% utilization. But when it comes from Cochin and reverse, it is typically empty. So you will get approximately a 50 to 60% overall capacity utilization. Year one, I think that would be probably closer to 40-ish% of the overall capacity. And what we foresee is that it will not lose money. Of course, the first year you have depreciation and interest, and that continues. But the sector is profitable, so we do not intend to lose any money on the first year itself. And let's not forget, this is a second-hand ship, so the acquisition cost is not that high compared to a brand new ship, and we tend to optimize that also with these kind of acquisitions.
All right, Vineet, for the first 9 months, your margins are roughly around 9.5%. Now, more revenues coming in from the Seaways business will be margin accretive, right? So going ahead, what kind of a blended margin can we look at?
So, yes, I think the year end would be this 9.5 to 10% EBITDA margin for the full year. We expect the next year as a guidance, overall top line growth to be the excess of 15% and bottom line growth to be the excess of between 15 to 20%, and in fact maybe higher also. So that would be the blended margin structure.
How has growth been in your freight business as well as supply chain? Any kind of issues that you're facing there, or has there been a pickup in demand? If you could just give us an update.
Sure. So we actually get a sense of what's happening around the country with more than 1,000 offices. And what we've been seeing is that there is a certain amount of demand pickup post-GST. Maybe there is some shift from unorganized sector to the organized sector. But more importantly, I think we are seeing some demand coming back even in some of the engineering companies and engineering sector. Consumption growth has also been robust. Of course, e-way bill is something that is awaited in the first week of April, and that could slow down things a little bit. But for companies like us, which have high corporate governance standards and which are fully compliant even for e-way bill, we think we should benefit as well.
How will e-way bill slow down business for you, at least initially?
Not for us so much as the industry as a whole, because I think the complexity around building e-way bill for all small-time operators or even SMEs and other businesses will take longer. So not so much for us, but certainly for the industry as a whole.
Okay, Vineet, final question before we let you go. Your debt in the books as of the half year was at around what, 390, 400 crores? What's the debt number? And I think logistics was given infra status in the past budget. Have you refinanced any of that loan? So what's the debt? What rate are you borrowing at? And are you looking to refinance?
So consolidated debt at the end of the year would be around, with the post-acquisition of this ship, will be around 450 crores, which includes more than 300 crores of working capital actually. So they're quite secure. Our average borrowing cost is about 8% and under. We have not refinanced anything specifically because we've not seen that real benefit yet flow from the infrastructure status to the logistics sector. There has been no reduction in rates, and I think mostly the impact of the infrastructure status would be in new capacity additions, specifically in warehouses and other such areas. So really speaking, not any major benefits from the infrastructure status yet.
Okay. Thank you very much for that, Vineet. That's the word from Transport Corporation of India. By the way, now the Nifty has given up half its gains. It's up less than about 50 points. For the Sensex, we've lost about 170 points from the top of the day. And let's get the Hang Seng once again up for you on your screen. Nigel was talking about how Hang Seng has come in for some amount of selling pressure, now in the red for that index, so down close to about 0.2, 0.3%. The intraday, there you have it. Selling pressure continues for that index. We'll slip into a short break. When we return, we'll get you some, as we slip into a break, let's get you some market opinion. Here out Saurabh Mukherjee of Ambit Capital, who believes that while the market valuations are high, we are looking at a pretty healthy economic recovery.
Now that valuations become a little bit more sensible, I still think the market's 10-15% overvalued, but at least valuations are a little bit more sensible than they were back in January. I think we'll see some degree of FII buying. The economy is in good shape. Valuations are still, I think, a little too high, but slightly more realistic than we were in the last 15 days of January. If you ask me, is Sensex 33,000 fair value? I would say Sensex 30,000 is where we should be now. Whether Sensex 30,000 will come next month or next year is anybody's guess, but I think we're still a little too rich on valuations. We're clearly looking to play what looks like a pretty healthy economic recovery, and therefore sectors such as metals and mining, which are a natural play on a recovery, I think should do well, especially if you continue to get global prices of metals rising. In the 6, 7, 8 month run up to general elections, I think rural India will do well. It's reasonably clear now, the government said it several times, they will spend a great deal of money on rural India in the next 7, 8 months. I think somewhere around 2 trillion rupees will probably get spent on food subsidies in FY19, and that should give rural linked stocks a nice fillip.